Hello everyone, welcome back to this final part on this lecture on return on invested capital and growth. And in this part I want to talk a little bit about the patterns of growth. So how does growth typically manifest itself and what are the empirics behind growth? So just to give you a little bit of an idea of hey, how do we actually translate expectations of growth into numbers, how to kind of double check with yourself whether those numbers are realistic, and what types of numbers we should think about when we're thinking about realism here. So most important part about thinking about growth is that growth is very hard to sustain in the very long term. And this all has to do with market saturation. So for instance, if we look here into to this graph from the McKinsey book, you see the product life cycle over all these different types of appliances. And even though these are very different appliances, so telephone, automobile, electricity, and all the way to the right, the internet, and in the middle there also the VCR, very different types of industries, they all follow more or less the same pattern. And of course it's very logical, right? So what happens for any successful product is, first of all, some people jump on board, they start buying this product. And then as more and more people start buying this product, eventually the market becomes saturated. So for instance, if you look here into something like something very basic like electricity, then you see the pattern here for electricity that nowadays, pretty much everyone except for maybe some homeless people has, even those guys, right, has electricity. So the market is completely saturated. So you're not going to find any additional people to sell electricity for. If you want to sell electricity to someone, you likely have to take them away from another type of provider. And the same goes for pretty much anything. So for instance here for internet in the early 90s, almost no one had it. That was one when I was playing Diablo over ISDN. So this is really this early adopter type of phase. And nowadays, well, this internet here is also going to go to, well, close to 100% or so, right? So this just means that at a certain point, markets will saturate. And then once markets start saturating, it becomes very hard to sell your products to new customers because, well, those early adopters, they are typically willing to pay a high price for your product. But the people that have not bought your product yet, well, they haven't bought it yet for a reason. So it's like you're going to be very hard to attract them. Of course, this will differ a lot by company, but the type of pattern is typically the same. So for instance here, if we have a graph for eBay and Walmart, their growth trajectory, what you see is that eBay started at the beginning by growing a lot faster than Walmart. But the growth was also over a lot quicker. And Walmart, even though it started at a lower growth trajectory, it grew for more and longer than eBay. And that kind of makes sense, right? So Walmart is placing all its stores all across America. And then, of course, it wants to start in those places where it can attract those high-paying customers, so get a good profit margin. And then slowly expand to other regions which are still profitable, but maybe a little less so. So that kind of seems like this very reasonable type of organic growth. And for eBay, well, it's slightly different, right? Because, well, eBay, you simply have your marketplace, you can attract a large customer base almost immediately. But then at a certain point, everyone knows that your product is out there, and then, well, what more can you do, right? Then at a certain point, the growth is simply somewhat over. It's not like it's going to be very hard to find anyone that hasn't heard of your platform yet to attract them. So it kind of makes sense, but the thing to note here is that even though these are widely different types of companies with widely different growth patterns, you still see this decline in growth over time. So in the end, you expect that growth is very hard to sustain. And that's more or less why every company at a certain point in their life cycle will come into this phase of stable growth. So typically, if you want to model growth in your valuations, you have the choice of stable growth, two-stage growth, and three-stage growth. Stable growth for companies that are very mature, so that don't grow as much anymore, except for with the economy as a whole. So as people start getting richer, of course they're going to buy more products, and you can kind of assume that most typical companies will grow with the rate of the economy. And so these are for, let's say, a company like Walmart nowadays, where they are simply a mature company where you can expect a stable growth. For most companies that you want to value, you're going to use three-stage growth. So three-stage growth, you have this company that is growing by a lot right now. So let's say company like Facebook, company like Spotify, or the company like Uber. Those companies are growing by a lot right now, but at a certain point in time, they will come into this phase of stable growth, because, well, they attract more and more customers. It becomes harder and harder to attract new customers. At a certain point, there's simply not that much. There's simply not that much to grow anymore. So they will eventually end up in this pattern of stable growth. So what happens intermediately? Well, then you simply interpolate between the stable growth phase and the high growth phase, and that's this. So here, high growth phase, here the stable growth phase, and then interpolating, you kind of have this declining growth pattern, which you can model. Two-stage growth is a little bit rarer to have, but can be something that you can use for stuff like patents, where you have a high growth phase in which the patent is still viable, and then at a certain point the patent expires, and then anyone can start making your product. So what you kind of expect is to make high profits and grow by a lot for the time that the patent is in place. And then as soon as it expires, a lot of your competitors will swoop in, also start making that same product, and you enter into this immediately enter into this phase of stable growth. So a little bit more specialized, but can definitely be the type of growth pattern that you see. For most companies, if you want to model growth, you're going to have either stable growth or three-stage growth. Yeah, okay, so I talked about this. All right, so let's do a little example of three-stage growth. So what does this look like? Let's look at Spotify. Right now it's making an operating loss, but you kind of expect that Spotify will make a profit in the future. And because Spotify is making a loss, typically for these companies that are making a loss, you want to look at revenue growth. So current growth in revenues, so between 2018 and 2019, right here is going to be 29%. So in this case, that's going to be 6764 over 5259 minus 1, right? And that should give you something like 29%. Can't do this by head, but I calculated it before. So right now they have this growth of 29%. Of course, not going to sustain that forever. So we have to start making some assumptions. So what are we going to do? Well, we're going to say at a certain point Spotify will have stable growth. We'll be in this period of stable growth. When is that going to be? Well, then you have to start making some assumptions. But let's say I assume that's going to be 5 years from 2019, so in 2025. Something like that. Very common in valuation practice to take like this 5-year period for between high growth and stable growth. 10 years also very common. Why? Not really hard and fast rule, but just this is something that people in practice do a lot, either 5 or 10 years. So here, let's take 5 years. So what do we do then in terms of the growth rates? Well, we start in the high growth phase, which is right now. We just calculated 29%. Then for the stable growth, we typically assume that this is the growth of the economy as a whole. So what is typically done for this stable growth value is the risk-free rate. Because, well, at a certain point you expect the risk-free rate, the growth of the economy as a whole to be equal to the risk-free rate. So this gives you a fairly good estimate for the stable growth. We'll talk a little bit more about estimating terminal value and stable growth. We'll go in there. I think that's maybe next week, maybe a week after. So we'll definitely talk more about that. For now, let's assume this stable growth of 3%. So what does that mean? Well, that means that intermediately, so here I'm going to have something like 25% growth. In this, in 2021, I'm going to have something like 20% growth, etc., etc., all the way down here to, let's say, 8%, and then here it's going to be 3%. And then we can calculate, hey, what are the revenues? Of course, then once we obtain those revenues, we can ask ourselves, but is this revenue number realistic? And for that we need to, we can kind of triangulate. So where, and this is good practice regardless. So rather than saying, hey, these are my assumptions, let's just throw in some numbers. Of course, you always want to double check, do my assumptions make sense? So let's try and see if they make sense. So how do we do that? Well, we can start approaching the growth from the other side. So rather than saying, hey, this is where we start at this 29%, and then slowly our growth is declining up to a steady state, we can also start imagining, hey, what does steady state look like, and then work our way backwards. So let's try and do that. So how would I do that? And of course, there's no hard answer here. But what you, for instance, can look for is the total revenue in the market. And then you can start imagining, okay, but what will the world look like in terms of the music industry in 2025? How big of a part will Spotify have in this market? And then we can work our way backwards. So, for instance, here I found this report by, let's see what's called, the International Federation of the Phonographic Industry. So no Freudian slip by me, luckily. And they find that, hey, there was this peak in the late 90s, early 2000s of $21.5 billion that was expended in terms of music revenues. And then there was mostly CDs, right? So here, part of this 21.5 billion was me buying my doom metal and stoner rock CDs. So Kai's very, very good stuff. And then you slowly see that, hey, Napster got introduced, and no one wants to buy CDs anymore because they're simply not convenient. I mean, I have had a Discman, and it was a horrible way for listening to music. MP3 players were much nicer, and phones nowadays, of course, as well. And for a while, people simply downloaded their songs illegally. And at a certain point, well, you had these streaming platforms that came up. So here, near the let's say the 2010s, here Spotify really started growing. So with this, let's make a little assumption about what the music industry will look like in 5 years from now. So let's assume that in 5 years from this 2019 data that we have, music consumption is back at its peak of 25.5 billion. So it's going to be, right back here. So let's see, not entirely sure why this is so different, why this is not 21.5, but let's assume that this is, right? So let's assume that in 2024, music consumption is at its peak of $25.5 billion. And let's assume that this will be dominated by streaming. If we look at the data here, this seems fairly likely that streaming is going to be this big chunk of what the music industry is going to be like. And let's then also assume that a competitor of Spotify comes in, and Spotify owns half of the market. Then we can ask ourselves, how much revenue will Spotify make in 2024? And yeah, that's going to be 11.34 billion. So now we can triangulate the calculation we had before with these new assumptions. So in the three-stage growth model, under the assumptions we just made, we got to revenues of about 14.53 billion. So that's about 30% higher than the number we find if we assume that in 2024 the music industry is going to be just as big as it was in 2000. So this is pretty generous, right? Because, well, back then a lot of people bought CDs, and CDs were very, very overpriced. So this is fairly generous. And then 90% will be streaming. Spotify owning a half of the market also seems fairly generous. So these are all somewhat generous assumptions. And even with these generous assumptions, we come to revenues that are about 30% lower than the estimation we made before. So this likely means that our estimation is somewhat off. So what should we do? Well, likely we want to adjust growth expectations. So either use like this exponentially declining type of growth, or maybe maybe moderate our growth in another way. And then after we estimate the growth, we can start estimating what are the profit margins and then what are the free cash flows. We'll talk more about that later. So if we then these are like the patterns of growth. So what does the data actually say? So what the numbers actually say about how big growth is on average, and what do we see in practice for growth? Well, over 1965-2013, median revenue growth was about 5.3, and high growth rates tend to decay very, very quickly. So let's first do a little quiz. So which of the following is most accurate concerning corporate growth rates? And indeed, high growth rates, they decay quickly. So if we then look into the data, so this 5.3 real revenue growth, you can ask me, hey Mark, why is this 5.3 real revenue growth so much higher than average US GDP growth? Well, because it's public companies. So these public companies, they self-select. So companies become public when they have a good business model, when they grow a lot, because otherwise, why become public unless you need access to a lot of new capital? So there's some self-selection there. So let's say you're the company owned by your brother-in-law, where he just fixes roofs for people. Well, that guy's not going to grow by that much, but let's say Amazon or so is going to grow by a lot. You can also have that these companies, they expand outside of the US. So where a lot of these low growth types of activities in the US are, so let's say mining, stuff like that, is outsourced outside of the US. And of course, there's all these other types of growth, but these are some of the most important ones. And if you then look into how sustainable growth is over time, you see this very rapid decline of return on invested capital. And so if you look into, let's say, the companies that are in the highest bracket of growth versus the lowest bracket of growth, so these guys are even declining in growth, then there's in year zero there could be like this 30%, 35% gap in growth rates. But after, let's say, 5 years or so, the difference here is closer to 5%. So even these companies that are growing by a lot right now, those types of companies will typically also, their growth will typically also peter out over time. Because at a certain point, well, the market is just saturated. So if you're going to model growth in your valuations, keep in mind that at a certain point, everyone goes to stable growth. You can't sustain high growth forever. So that brings me to my concluding slide on ROIC and growth. So the key to having high return on invested capital is having some sustainable competitive advantage. And then the key here is that you can explain what is this competitive advantage that I have. So what is the reason that this company will have profits, and how does this lead to a sustainable competitive advantage in that it should be hard to copy, because otherwise it's not sustainable. And then once you have this reason that you have this competitive advantage, you can start thinking about, okay, but does this competitive advantage translate into high prices? Does it translate into low costs, or does it translate into efficient investment? And then you can kind of see what drives the value creation of this company. And then about growth, most important is that it's very hard to sustain growth over a very long period of time. So products have this natural life cycle, and at a certain point, markets are just saturated. So you cannot sustain this very long, very high growth over a very long period of time. ROIC, more likely that you can sustain relatively high return on invested capital over this very long period of time. And typically companies with high return on invested capital will tend to have high return on invested capital even as they mature. Even though, of course, this will also decline over time. So this is it for me for this lecture. I'll see you guys next week.